Lending and LLCs, practical steps to avoid underwriter issues. Lending to or through limited liability companies can create underwriter friction that delays or defeats loan approval. Underwriters often require clear documentation and 2 months of bank statements showing seasoned funds. Funds moved from an LLC into personal or target LLC accounts immediately before closing will trigger questions about source and ownership. If you keep investable cash in a protective LLC, distribute the exact down payment amount to your personal checking at least 2 months before making an offer. For purchases where the LLC will be the borrower, distribute funds to yourself and then contribute them to the purchasing LLC at least 2 months before submitting that LLC's loan application so the money appears on 2 months of bank statements. Avoid using leveraged financing inside self-directed retirement accounts unless you understand tax consequences. If financing is required, ensure non-recourse structures and season funds into the account 2 months in advance. For multi-entity portfolios, use a holding company that files as a partnership and issues K-1s. Lenders view K-1 income in a partnership filing as stronger business evidence than a long Schedule E list of properties. In short, plan entity funding and timing ahead of offers, season funds for 2 months in the account where the lender will look, and present partnership tax filings when possible to reduce underwriter confusion and improve loanability.